Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Torsten Slok of Apollo writing, the consensus expects inflation to rise in the US, but fall in the Eurozone. Torsten joins us now for more. Torsten, let's focus on the US side of things, and then we can get to a more global dimension. Let's focus on the US with the tariffs in mind. Is it too early, Torsten, to expect those tariffs to show up in the data this morning?
No, it's not. What really is the key issue here is that there is indeed going to be some upside pressure on inflation. And what's most critical about this is that it's all about the behavior among companies. How do they respond to tariffs? Do they pass on 100%? Will they pass on 50%? Or will they pass on nothing? If they pass on nothing, of course, then tariffs have to be absorbed by the E and the PE ratio, namely by earnings. So it becomes very important, the data print today and for the coming months. And we should expect to see some upside pressure on inflation coming from tariffs. But it's also the upside pressure we're watching that's coming from what's going on with the dollar. The dollar is down quite significantly since the beginning of the year. This is also beginning to creep in as a risk to the upside for inflation. And finally, the other thing that's also beginning to become a risk is that the restrictions on immigration. We saw last Friday some upward pressure on wage inflation. This is also something that's an upside risk to inflation over the coming months. So the bottom line to your question, Jonathan, is that we should expect to see from a number of different forces upside pressure on inflation for the next several months, including in the data today.
Will it be sustained beyond the next several months, Torsten? As you alluded to, as you indicated, that is the key question right now, the central question for a lot of people in financial markets. What is on your dashboard that guides that for you?
Well, my dashboard is to type ECFC go on Bloomberg and look at what the consensus is expecting. And that will tell you that CPI is expected to go up from 2.6 to 3.3 by the end of the year. So that's roughly a half a percentage point increase in inflation. And that's the same for core PCE and for headline PCE. So the issue there is that we should expect to see this take quite some time because it all depends on the company's behavior in terms of when do they begin to implement higher prices on the back of inflation going up. And that is something that in the profile of inflation unambiguously pushes us up above 3%. And this is very important because the starting point, if we had started with inflation today at 1.5 and we had 0.5%, then we will get much closer to the Fed's target. But the problem is that the levels we're at, 2.8 of inflation today, is already at a level that is significantly above the Fed's target. So if you add a shock of lifting another 0.5 percentage point to inflation, that really complicates the Fed's job and therefore makes it very difficult for them to cut rates in an environment where there's so much upward pressure on inflation.
So Torsten, in an all other things being equal world, right, when you slap a tariff on, the price of those goods move up. I think that's clear. There are some offsets, though, potentially, and I'm interested in your thoughts there. One, right, energy prices have been lower now for a kind of sustained period of time, so there's some disinflationary potential there. Also, the ISM service number last week came in below 50, and so there's some signs of slowing in the service economy. So how do you think about some of those potential offsets, and do you think they're enough to maybe stunt the impact of what you're expecting from a tariff perspective?
No, you're right. From a growth perspective, lower energy prices is certainly helpful. But core PCE and core CPI, of course, excludes food and energy. So from the Fed's perspective, they would likely focus on that there is general upward pressure in the broader measures of inflation, excluding food and energy. And to your services, it's right. NFIB has been showing some upside pressure also on the expectations to inflation. There's also some measures, of course, of inflation expectations, both from the University of Michigan and the Conference Board, that is also telling you that inflation expectations are way too high relative to where the Fed would like them to be. So you're right, there are some nuances in terms of, yes, there are different things going on in some of the, especially survey-based data of what's going on with inflation, especially when it comes to household expectations being very, very high. So combined, I would still come to the conclusion that I worry more about the upside risk. This is also what the Fed has in their own forecast. That's what the consensus is forecasting. That's also what we're forecasting. So for what it's worth, I still think that the overall risks, yes, surveys may show that ISM was a little bit weaker when it came volumes to prices paid. But the bottom line is that the tailwinds coming from tariffs, coming from a lower dollar, coming from restrictions on immigration are just pretty strong. And that's combined with, at the same time, a slowdown in growth, partly because of tariffs, of course, also weighing on sales for companies, but also a slowdown in growth because of the new factor that's emerging, namely consumers are beginning to take a hit now because student loan payments are restarting and people are beginning to take a hit on their credit scores if they don't pay their student loans. So the New York Fed is estimating that's as much as 6, 7, 8 million households that now are at risk of no longer being able to get credit. So that's a headwind to growth, while we at the same time have some upward push on inflation. So that's stagflation in a nutshell as the baseline scenario that we view as the most likely case at the moment.
Torsten, that final point is so important. Are consumers in a position to eat it? And is the labour market tight enough for them to demand the higher wages to fund it? What's your assessment of that situation now?
So one way to assess that is, once again, to go to your Bloomberg screen and look at the Red Book same-store retail sales. That went up a lot just immediately during the Liberation Day weeks when we had, of course, a lot of people that were front-loading their purchases. But in the last several weeks, the same-store retail sales data from Red Book has started to show a seeping lower. We're now below 5% in nominal growth for same-store retail sales. We are watching that trend very, very carefully. And this is weekly data that comes out every Tuesday at 9 a.m. That will tell us something about, is the consumer really in such great shape as their balance sheets would be saying, or are these headwinds, especially headwinds coming from tariffs, headwinds coming across the board, especially from the student loan problems that are beginning to emerge. And they only really started emerging here in May. And we are worried that the U.S. consumer could begin to slow down. And we're beginning to see some signs of that trend downwards in the Red Book same-store retail sales data.
What you're describing is potentially a nightmare for the Federal Reserve. You talked about the dynamics playing out in Europe. The ECB has been reducing interest rates now for a number of months. Torsten, where do you think it leaves the Federal Reserve at a time when I hear a lot of people saying they should just sit this out for the summer and maybe sit this out for the rest of the year?
That's extremely important because this issue is, of course, exactly that. If you have higher inflation, the Fed should be hiking. If you have lower growth, the Fed should be cutting. So which one is it? Does the Fed like apples? Do they like oranges? How much weight do they put on inflation going up? How much weight do they put on growth slowing down? And the dual mandate is torn in two completely opposite directions. That's why the easy answer to that for the FOMC members is to say we're not doing anything. But exactly to your point, Jonathan, what if the inflation data does start to move up much more? Or on the other hand, what if growth starts slowing down more? It's a really difficult spot for the Fed to be in because monetary policy works with a lag. FOMC members will say that's as much as 12 to 18 months. So it's almost impossible for them to catch this falling knife because we just don't know at this stage whether the growth slowdown will dominate or whether the rise in inflation will be dominating.
Hey, Torsten, provocative stuff. Appreciate the catch up. Torsten Slok there of Apollo. Build on the conversation with a perfect guest, Bob Diamond, the founding partner of Atlas Merchant Capital and the former Barclays CEO. Bob, good morning. Good to see you.
Good morning, Jonathan. How are you?
I'm good. It's good to see you, sir. Let's just recap things. Where are we right now? Big 30,000-foot view of the banking sector in America. How are things shaping up?
You know, I think just kind of the back and forth, and on the one hand and on the other hand from Herman suggests pretty much my view, which is kind of a balance. I think we'll see a turnaround in deal making, in advisory in the second half of the year that was a bit slower than people expected in the first half. I don't think Wall Street will repeat the kind of trading performance they had, which was kind of like Christmas in the first quarter for trading desks with all the volatility. But I think it's a good environment. So no big warning signs. I think as you said, the report from Citi that loan loss provisions are a bit higher is not surprising. I would be very surprised if they're more than a bit higher.
An okay environment for the big banks or for the smaller banks as well?
Well, it's a great environment for the smaller banks. And as you know, we're very focused on regional and community banks. We've done our first close in a investment strategy for that sector. We think that the 4,500 regional and community banks, one, they're incredibly important to the economy. They do over half of the lending to small businesses and family-owned businesses, but 4,500 is probably the wrong number. And many of the smaller, more private community banks that are so important to their communities are frankly just too small to succeed with higher technology costs, higher regulatory costs, higher compliance costs, and Jonathan, what we're seeing is with a focus of our banking expertise, our integration expertise, the CEOs of these banks want to take part in consolidation. The opportunity to increase ROE through cost synergies, particularly on in-state transactions, is terrific. So I think in addition to that, as you look at the go-forward business opportunity, we have higher rates. They're probably trending somewhat lower, but not too aggressively, and very high demand for credit. So the environment could not be better for a strong regional bank today.
Bob, we often hear that tariffs and rates act as overhangs on potential M&A and consolidation. But stepping back, there's also a tremendous amount of disruption going on at an industry level. AI is disrupting many industries. You still have this transition in terms of office and real estate post-COVID. You have the energy transition, and we'll see what happens with reshoring. So would you argue that disruption in and of itself is going to lead to more industry consolidation and M&A across various sectors?
Yeah, I don't think that's a bad hypothesis, particularly with AI. I think looking at financial services again, which is kind of our expertise and our focus, it's nothing but positive in terms of, in the first stage, greater efficiency. And even where there's been that disruption in the U.S., the U.S. economy around uncertainty and tariffs, we have a couple of broker-dealers that we're invested in overseas, Panmure Gordon in the UK and Kepler Cheuvreux in Paris-based, but really focused on Europe for equity sales, trading, and research. They both had record earnings in the first quarter for flows from U.S. investors into the UK equity market and into the European equity market. It's incredible to me every time we see these disruptions. It's like the markets are reacting almost before we're ready to do the analysis. So those are first quarter numbers at Panmure Gordon and Kepler Cheuvreux, and they're records for the firms in terms of flows from U.S. investors into the UK and into Europe. So it's amazing how agile the investors are.
I was going to follow up and ask you about that because I know you have a very global experience throughout your banking career. And it's also just stunning to think about how soon the January American exceptionalism thesis turned into Sell America after Liberation Day. Do you see those trends in terms of flows and sentiment moving away from U.S. markets continuing, or is it more of a kind of a near-term blip?
I think there are reasons to continue. So one of the reasons is it's been a big divergence almost since 2008 and the great financial crisis, certainly in banks. But really in equities in general, the outperformance of U.S. equity markets has been very clear relative to the UK and Europe. So you had a bounce coming, and I think one of the catalysts for that is this administration's kind of gave a boot in the butt for the Europeans to say we really have to focus on spending. We really have to focus on private sector. We really have to focus on the economy growing. And I think the attitude change across Europe and the attitude change in the UK toward private sector success, business, profitability has been positive for them. So I think the U.S. is still like the leading economy. It's so, the financial services industry is so deep. It's just such an impressive machine. It's not a negative on the U.S. necessarily. I think once we work through the uncertainty around tariffs, we'll see the strength. But a bounce in Europe and a bounce in the U.K. was coming.
Do you still see the policy mix from this White House as pro-risk, pro-growth?
I think, to me, Jonathan, the single thing that investors are looking for right now, well, there's not one thing, but if I picked one out, it's certainty. And I think, calming down the situation with U.S. and China would be a very big part of that. So I think the announcement today, if we move forward with solving some of those situations, I mean, keep in mind, if you go back like 10 decades, then, tariffs were like 2.5% on average. They got up to 25 or 30% with all of the noise. If they settle around 5 or 6%, I think we have we have confidence again and we have certainty again. I think we'll have deal making come back. So I think this is a big moment. And I think what's been recognized is that China actually has some pretty strong cards. Rare earths is one of them. But, as you look at the latest numbers, China still had an increase in exports. Exports to the U.S. were down 30%, but exports to the rest of the world were up 11%. So overall, their exports were up.
Up more than 20% to Vietnam.
Right. So less than 10% of their exports are to the U.S. today.
Dan, this is something you talked about. The last few months have revealed the leverage that the Chinese have this time around, maybe in a way that wasn't really enforced several years ago in the president's first term.
Yeah, absolutely. And I think there might be some positives that redirect and reorder some critical security-based industries, technology, pharma, medical supplies, et cetera. But I think the theme that I'm just hearing from Bob is one we just talked about with Ed earlier, which is this unintended consequences. We've given a kick to Europe to start spending and maybe in many ways created better growth opportunities for them that they wouldn't have taken on earlier, much like the DeepSeek analog.
Bob, does that mean that you're more focused on the US as everyone starts to look elsewhere? That maybe there's better opportunities here now?
Relative to the last 3 or 4 years, I think the opportunities in the UK and Europe are there. But Jonathan, one of the things we felt in Atlas Merchant Capital was one of our real competitive advantages in financial services is we're focused on the UK and Europe in the US. Prior to COVID, we had done just as many investments in the UK and Europe as we've done in the US. Since COVID, it's been US, 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 because that's where the opportunities are. So I would say it differently. I hope we continue to see opportunities here. And US regional and community banks writ large, that's a phenomenal opportunity in the US. But if you give us more opportunities for growth in the UK and Europe, then Atlas Merchant Capital is going to be very, very busy. And that's the direction it looks like we're going in.
Just give us the number quickly again. What are we at now? Regional banks in this country? 4,500?
4,500, and it's probably the wrong number.
And you've got us coming down to what?
I think 3 years from today, market down will be at 1,000 to 2,000.
It's a punchy goal, that's for sure.
Punchy goal.
You could be a big part of it too. Bob, it's good to see you.
Good to see you, John.
Thanks for dropping by. I appreciate your time. Bob Diamond there of Atlas Merchant Capital. With me around the table, Greg Peters of PGIM, Seth Carpenter of Morgan Stanley. Seth, just your first take off the back of that data. Not in line with what you were expecting.
No, that's exactly right. We were expecting roughly with consensus that it'd be up, 2-3 on core. I think one thing that's important to remember, though, is there are lots of moving parts here. We had already seen lots of swings in things like used cars before. We are coming into this year on a deflationary trend or disinflationary trend. And so, I think we got to just take this as 1 month's worth of noise. The other thing, though, is it's still early game. So when we look at what happened before with tariffs, it did take 2 or 3 months before you saw any sign of the tariffs and the inflation data. And so I think this is still the beginning of the game, not the end of it.
Timing and sequencing is really important. I know you've done the research because I've read it. The data this morning, you called it noise and not signal. What was the experience of the tariffs in the first term under this president? And the timing and the sequencing of things, the hit to inflation, then the hit to growth. And why should we think it's going to be the same this time around?
Yeah, I mean, I think what's really tricky is it does seem like the inflation comes from the tariffs after 2 or 3 months. The hit to growth comes after 2 or 3 quarters. And so that mismatch in timing, I think, makes it hard for markets, but very hard in particular for the Fed. I think in 2018, one of the big changes then versus now is that it was mostly focused on China. If you look hard in the core consumer goods data, you can see the effect of inflation, but it was transitory then. We have every reason to suspect it'll be temporary this time. But the numbers are bigger now. All around the world, tariffs, bigger tariffs on China, modulo whatever sort of deal comes out from London. And so we think there's a big difference there. Also muddying the waters, though, we know how much front-running there was before the tariffs coming in. So is that going to change a little bit, the pricing dynamic? Easily could do.
Greg, would you fade any excitement this morning around this print?
I would. I agree with Seth. I mean, it's way too early to make any kind of determination around this particular number. The one question I have for Seth, though, is,
Sure.
How do you think about 2 components, the housing component, which is key because that also feeds into growth, and then the service sector, which is basically a measure of wages and labor health. So a lot of investors are excited around services disinflating, but that's actually kind of very much a double-edged sword. How do you kind of think about that?
Completely agree. It's a double-edged sword, and I think it's complicated. I think from the housing, it's a national phenomenon, and it really will reflect the tightness in the labor market. There, we've been expecting that to continue to drift down close to pre-COVID rates, month on month, maybe not going below it, but getting close to where it was before. For the rest of services, though, I think we have a countervailing force that needs to be more on people's radars. When it comes to policy effects on the economy, on markets, everyone's been focused on tariffs. Don't forget we've got immigration restriction. Immigration restriction matters a lot. We think prior to COVID, the run rate, sort of break-even rate for non-farm payrolls was probably 110, 120K. 2023, that run rate went up to 240, 250K. It's going to drop to something closer to 75. That's a meaningful restriction in the growth rate of the labor supply. And people here should remember what it was like coming out of COVID when it was hard to find workers. You saw hotel buildings, for example, where like the top 10 floors, for example, were just left vacant because they didn't have staff. I think those sorts of staffing shortages are very plausible, and that could be putting upward pressure over the second half of the year for the services outside of housing.
Not much pressure right now. If you are just joining us, a downside surprise on headline and core CPI. Month over month, it came in at 0.1%. The median estimate in our survey, 0.2 on core. Taking out food, taking out energy, it came in at 0.1 against the median estimate of 0.3. Mike McKee standing by. Mike, I want to come back to you. You've been digging through the details. What's the source of this downside surprise? Where's the surprise coming from?
Well, overall, John, it looks like goods prices did not rise. They were flat during the month, which is not what was expected. Services prices were down. Gasoline prices fell 2.7%, so that had a big weight. The thing that did prop up inflation was, as you guys have been talking about, housing, but a couple of other areas that did surprise. We saw a slight rise in home furnishings, about a 0.2%, but apparel is down by 0.4. That was expected to rise. And here's the real surprise in these numbers. Used cars and new cars both fell in price by 0.5 percentage point. The expectation was tariffs would drive those higher. Airfares were down as people kind of expected, given the travel fall off that we've seen, down 2.7%. So there are some surprises, some non-surprises in here. I was going to mention, John, you were talking before the number came out about the cost of Hulu and all those other subscription services. They were up 0.6%, one of the larger rises in the CPI this time. I think maybe what we're seeing is companies selling out of the inventories that they pulled in. That could be one of the explanations for not seeing kind of the tariff effect that we thought of.
And Mike McKee, thank you, sir. We're all feeling that price pressure on the Hulu side of things, that's for sure. I'll talk about that another time, no doubt. Seth, what did you make of that explanation?
Yeah, I mean, I think what Mike said was there are a lot of different components that are going in lots of different directions. And I think that's exactly where we've been for the past, call it, year, where the underlying trend before the tariffs hit was a downward trend, but boy, was it not uniform. It was all over the place. I think the car prices point is a really important one. If you look at the month-on-month changes of both new autos and used autos over the past, call it 12 months, you'll see some big swings in both directions. And so again, the noise versus signal, the noise is very high right now.
Seeing some swings right now in the equity market and in bonds too. Equity futures near session highs going into the opening bell about 50 minutes away. The equity market is positive by 0.4%. Just move to the bond market, though. This interesting move here. Compare the 2-year to what the 30-year is doing this morning. People like Greg would call this a bull steepener. Rally at the front end of the curve. Yields dropping by 6 basis points. And a 30-year basically doing nothing. What does that speak to?
This speaks to everything we were talking about, which is, all the concerns manifest in the 30-year, right? So the front end is driven by Fed policy. And the back end is driven by a lot of other factors. And there is this pesky auction later this week. And so I don't really see a scope for that to rally into that auction. It normally cheapened up beforehand. So I expect it to continue to cheapen up beforehand.
A 30-year supply coming tomorrow afternoon, 10-year maturity. Issuing debt, the Treasury a little bit later on this afternoon too. So yield to lower at the front end of the curve. We're down 6 basis points on 2s. That unlocks some dollar weakness. Euro dollar right now, 114.75. Joining us now to extend the conversation, I'm pleased to say, is David Kelly of JPMorgan Asset Management. David, I just want your initial reaction to the data we got about 10 minutes ago. Was that a surprise to you, sir?
And not too much of a surprise. As we were going into this into this print, we were looking at a lot of the different industries, and there's a sogginess in the economy which is really preventing prices from going up. I mean, one of the things that I was struck by was that both airline fares and hotel lodging were down. And that really jives with the fact that, people flying and people staying at hotels in terms of occupancy rates have both been very solidly down for weeks, if not months here. And then at the retail level, I think it's just like businesses and consumers are eyeing each other nervously. Consumers, feel badly about the economy, not sure, and retailers just don't have the nerve to raise their prices until they absolutely have to. But I think the tariffs will mean they absolutely have to in the next few months, because a lot of these retailers work off tight margins. So I think we are going to have a further delay to the delayed reaction to these tariffs. But if the current level of tariffs stick, we do still expect this inflation pressure to rise over the months ahead. And I think by the end of the year, we're talking about a CPI about 3.5% year over year, consumption deflator north of 3% year over year, even though it's taking some time for this to materialize.
David, here's a counterpoint. It comes from Neil Dutta of Renmac this morning, who said if tariff rates are up and core good prices aren't up by as much as the consensus thought, it implies more margin squeeze at retailers and less price pass-through. Why isn't that just going to be the sustainable story for the next several months? Why does it have to get worse?
Because the retailers won't be able to do it. I mean, these margins are tight, and what they're doing is, for their existing inventory, they paid a certain price for it, and they're willing to, even though inventories are going down, they're willing to, accept current margins. But as they have to pay for the new inventory and mark up on that new inventory, I expect that we will see those higher prices. So it's because margins are tight in the retail businesses, and I think it's going to be very, very hard for retailers and auto dealers and so forth to actually maintain low prices if the prices of the stuff that they're buying goes up.
David, if they're not in a position to eat it, are consumers in a position to pay the higher prices? Do you see a labour market that's tight enough to demand higher wages to fund that move?
Well, we are seeing a slight tightening in the labour market because, as your previous guests were talking about, that I think this immigration squeeze is beginning to hit. And I think it's very, very much below the radar because a lot of these people don't really admit to being working at all. But there's a shortage of labour, which is getting worse. And I do think that's going to put a floor under wages. Now, for consumers overall, this is a tax on lower and middle income consumers. I mean, that's what tariffs are. They're a tax on imports of goods, and that hits low and middle income consumers. So it depends on the tax bill a bit, but assuming the effects of the tax bill don't kick in until later, then I think the squeeze is going to get worse over the course of the year, and you're going to see weak consumer demand, and so you're going to have a combination of an economy which seems to be pretty sluggish, say in the third quarter, but also prices which are registering pretty high year-over-year increases.
David, I've got to ask you, where on earth does that leave Chairman Powell and this Federal Reserve?
I think they have to wait and see what happens with this tax bill. You've got tariff inflation that's going to be followed by stimulus inflation unless they water down this tax bill. And I think he's right to wait and see. I mean, I also think that given how high the stock market is, he doesn't want to be responsible for causing a further party in the equity market and pushing asset prices even higher. So I think the Fed is going to wait and wait and wait until they know what the tariff story is and what the tax story is. And at that point, they can assess the economy. But until that point, they've really got no reason to ease.
David Kelly of JPMorgan Asset Management. David, thank you. Seth, you were following that conversation. Do you share that opinion the Fed's going to sit this out?
I do think so. I think right now there's no urgency for them to move. I mean, you saw the year-on-year number. Even with this downside surprise, the year-on-year number was 2.8. I haven't seen what my team has sort of done for the translation to core PCE, but you're still probably talking about something like 2.5%. And so even though that's well below the peaks we saw coming out of COVID, 2.5% is still a 0.5 percentage point higher inflation than the Fed's target. And to date, we haven't seen any deterioration in the labor market. So I think it's a very difficult proposition to argue the Fed needs to cut in June. Why not take the optionality, sit and wait? They can communicate their inclination to have the next move be a cut through their dot plot at the upcoming meeting. That seems fine. But I don't think there's any urgency on their part to move.
Have you got a clean read on their reaction function? They might not move, but do you have a decent understanding of how they would move based on incoming information?
So I think so. I think the simplest version of this, and this isn't going to be groundbreaking, is they've got two mandates. They have to worry about growth and employment on the one hand, they have to worry about inflation on the other. at any point in time, based on the current set of the data and then your best guess as to where things are going, which one's the bigger problem, and react to that one. And so right now, the bigger problem is very clearly inflation. It's come down, but it's still above target. The labor market to date is fine. Where are things going? Well, we start to make forecasts. We think inflation's going to go up from here. They probably think inflation's going to go up from here, but we don't know that yet. But until you get that confirmation, there's no reason for them to move. If we're right and inflation does go up, like I think is the consensus, before the labor market starts to slow, before spending in the economy starts to slow, well, that just reinforces the idea that inflation's the bigger problem of their two mandates. And so we've been saying for a while, don't count on a rate cut at all this year, because if inflation keeps drifting up before the economy cracks, makes it easy for them to just sit on their hands at the current level of policy rates.
Greg Peters, sitting on your hands through the summer is one thing, through the year is another. Are you expecting them to sit on their hands through 25?
It's data-driven, of course. That's my out. But we've been kind of penciling in 2 cuts just to get to kind of the top end of neutral. But it's a complicating factor. I think it's how you position the inflation. Clearly, they're going to be hesitant to use the word transitory, but there is this belief that it's a one-time shock, and you have to look through it. But my read is that they will prioritize growth. If you just kind of think about it, in the matrix, if growth moves down hard, I think we're pretty sure inflation's following, right? So I think they're worrying about and prioritizing growth over inflation, but they can't tell you that because they need to be credible on the inflation front. So you have to kind of look through, and kind of read in between, which is difficult to do.
Is that another way of saying Governor Waller has a luxury that Chairman Powell doesn't have?
Yes, but I think it's right, and there's some politics there too, right? So it's our belief is inflation rolls over. Growth rolls over. I think they'll respond to that, even though inflation remains well above target.
Greg, this was smart. It's good to see you as always. Greg Peters, PGM, alongside Seth Carpenter of Morgan Stanley. Seth, thank you, sir.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.